You're watching Stockwatch. I'm Simon Brown, and joining me to unpack your stock-related questions today, Shane Watkins from All Weather Capital, Graeme Körner from Körner Perspective. Be sure to send your questions through email stockwatch@bdtv.co.za, SMS 41392, on Twitter @BusinessDayTV using hashtag Stockwatch. Gents, thanks for the time today. Shane, let's start with you. Let's start with the big non-story, I suspect. 8 o'clock this evening, we get the announcement from the FOMC. Not likely to change rates at all, are they?
Simon, so, despite Donald Trump pressurizing the Fed, it seems unlikely, and certainly the forward markets are not pricing in a rate cut. But I think that, setting politics aside, indications are that there will be at least one, but probably two cuts in the course of 2025 in the United States. And I mean, you will have noticed that the Chinese central bank cut this morning. There have been numerous other cuts around the world. It seems that the only two central banks that are insensitive to calls to cut interest rates are the Fed and our own SARB.
Our SARB are hawkish in their DNA. They pour it into their tea at the meetings. Graeme, are you...
Well...
Sorry, Shane?
No, I just wanted to say something about the SARB. The SARB have always said that they are data-driven.
Yeah.
And now, inflation has come down to the lower bound of their target range. And now they say they're not data-driven, they are forward data-driven. So, they've kind of moved the goalposts in a sense, and in some ways they've become more hawkish than what they have been in the past.
Yeah.
Which I think it's pretty evident that if inflation is where it is now, and I mean, you can see that the oil price is down at $60 a barrel, and you can see that economic growth forecasts from South Africa have been revised from maybe 2% a year ago to 1.5% now. It's evident that growth is slowing quite quickly. There are no inflation pressures to speak of. And, I feel a little bit like Donald Trump in saying that there's just no basis not to cut interest rates.
Yeah, I mean, we've got a real rate of 8.3%, which is probably about the highest since that 1998 crisis when prime was at 26. And I remember that because that's when I bought my first house. Graeme, are you on the FOMC to do nothing tonight?
Yeah, very much so. I think after that it becomes a little bit murky because my sense is inflation will probably manifest before you see the growth effect. So, maybe looking forward a couple of months, it might be difficult. The Fed may say we're worried about a slowdown, but we're starting to see inflation. So I think we might be in that sort of awkward phase. But I think consensus is with Shane. I think he summarized it well. The market's probably somewhere between 1 and 2. Yeah, and I think if anything, the Fed will just ignore Trump's calls. And, I've said exactly what Shane has been saying, or just said for some time. I think the SARB is ultra conservative, and respectfully, we were probably slow out of the blocks. If you look at the first cut out of the Fed, they cut by 50, and we were, we started on this 25. So I agree 100%. I think we, you don't want to be critical because they were really diligent through many, many difficult seasons over the last while, but I feel our base rates are just too high right now going into what's a really sluggish outlook for 2025.
Yeah, and we had Moody's cut us to 1.5. We've got IMF having our GDP at 1%. Our minister, I think budget take one, said 1.9. We'll see what he says later this month. Graeme, let's stay with you. Question coming through: British American Tobacco. Is it worth looking at for a good sterling yield? There's a bit of a dying industry. I suppose the question is, can they hang on to that yield?
Well, I think that's the big thing. So the short answer is, I think no at $800. To really see the story, you have to go and look at what that has done in the UK. So if you strip the rand effect out, it'll tell you that business is, in a phase of structural decline. So, I was saying to somebody earlier when I started Körner Perspective some 15 years ago, it was our biggest holding. So 6%, and the narrative was one of premiumization, cost management, and you had good dividend yield with good visibility. But a lot of that is now done. I think lots of work being done to try and move into other let's call it nicotine fix solutions. But I think the barriers there are lower. So for me, that is a dying industry. I think you you're coming in at a quarter to midnight if you're looking at the life cycle of British American tobacco. So
Yeah.
no, I wouldn't be buying it. No.
And I remember that. I remember when they were focusing on premium brands, to your point, and it worked, and it got them better margins. But as you say, that has now happened. Shane, British American Tobacco for you?
Yeah, so Simon, I want to offer a slightly different view. Half of British American Tobacco's business is in the United States, and recent events there are quite good for them. I mean, in the first instance, Donald Trump has rolled back a lot of the regulations. For example, there was going to be a ban on menthol. That's not going to happen anymore. And generally, it's a good environment for them in the United States. The company is on about an 8% dividend yield. But the interesting thing about British American Tobacco is that they have an associate in India. They own 27% of this company. British American Tobacco trades on about, let's call it a 7 or 8 PE. The Indian subsidiary trades on a 30 plus PE. They sold 3% of it last year and bought back their own shares. It's likely that they will do that again this year. So selling something on a 30, buying something on an 8, it's very enhancing for them. So I would say that, notwithstanding the fact that what Graeme says about volumes is true, I mean, they're going back by between 5 and 10%, depending on what geography you look at. I still think that there's good upside in the share.
Okay. No, cool. Some contrasting views there. Shane, next day with you, a question coming through around coal miners, Exxaro and Thungela. We still need coal. We still use coal. Both have come under significant pricing pressure. Is there any value in either of them? Shane, would you be looking at one of our coal miners?
So I think Thungela is a well-managed, easy to understand export thermal coal business. Coal prices have been under quite severe pressure, but I think if you were going to buy one or the other, I would certainly buy Thungela. I find Exxaro's strategy over the last 15 years impossible to understand. It changes every second year. They expand into areas that they know nothing about. They've had a number of investments that essentially have proved worthless. Their business is simply not focused, and they've had problems both operational, strategic, and governance-wise. I think they're still in litigation with their previous CEO.
Yeah.
So I would absolutely avoid Exxaro. And if I was going to buy one, I would buy Thungela, which I think is a well-managed business with decent prospects.
Graeme, is coal also a quarter to midnight, or is there some prospect here? And would you be looking at either Thungela or an Exxaro, who busy suing the ex-CEO or being sued by? I think they got rid of their chief coal procurement officer. It's messy.
Yeah, messy is probably an understatement. I think what they're trying to do is reinvent themselves. Business that sees is called. They feel they're at quarter to midnight, and they're trying to move the clock back. So in answer to the question on Thungela, whether it is quarter to midnight, it's probably a quarter to 11, and maybe daylight savings gets announced in the next hour and a quarter. So I think that's actually the reality. That, to your point in the introduction, South Africa, for example, the world needs coal. You don't just flick a switch and suddenly we've got nuclear power, and that comes with a whole lot of pushback from many quarters. So I think the world needs coal. So it's probably not quarter to midnight. I mean, the valuation is basically one of you get your cash back in a few years. But I think the issue is for me has always been the fact that obviously Trump has rolled back a lot of the DEI and a lot of the environmental concerns, but there are a lot of investors around the world that consider this a no-go zone. Mm-hmm. And that's always for me an issue because if there are 100 possible investors today, maybe in 5 years' time there'll only be 60 or 50 of those who are still interested in it. So there's a shrinking base. I think the short term there's money to be made, as Shane said. I mean, coal prices have been under a lot of pressure over the last while. That's obviously hurt, but it's one of those. It's what Ben Graeme used to call a cigar butt. There's probably money to be made in it. There's a lot of cash flow. There's a lot of yield, but it's not one I think that you would want want to put in your bottom drawer and hold for 5 years. I think it's one of those if you buy it, you sit quite close to the door and recognize that it's got a finite life. Yeah.
Yeah, I take your point. At some point, you need to be exiting, and you need to therefore, stay close to that door. Question comes through around Datatec. Strong trading update for year-end February. I've long been thinking about adding some. Is there value in the stock? Graeme, it was a decent-looking update from Datatec. I have to be honest, it's not one I follow very closely since the heydays of the dot-com boom, which was 25 years ago. Have you got any more recent insights into Datatec?
I'm ashamed to say I'm exactly the same as you. I remember the old days that was Datatec and Complex and
Data,
Data and all of those. And I mean the reality is Jens has just put a really good business together that just delivers. It's in the right space. If you look at what it's basically a very different business to what it was back then. And I'm embarrassed to say, this thing has just sort of blossomed under our nose and gone largely ignored. But what was it? I think 13% or something like that, if memory serves.
Yeah,
it's a very credible result in this environment. So, I keep saying whenever they release, I really need to have a better look at this because it looks like a really well-run business. But I suppose the flip side to that is, it's essentially a global play, and if you've got money offshore, you're probably looking at the likes of Nvidia and Microsoft and Micron and others. So, or you could even be looking at the big component manufacturers. So, I suppose the question is if you've got money trapped in South Africa, I think it definitely looks like it deserves attention. But if you've got money offshore, I think the argument would be there are a lot of other options, and then you've got to consider it a little bit more measuredly.
Yeah, okay. And homework for you and I. We'll read up some before the next set of results. Shane, have you got any deeper insights into Datatec? Can you save the day for us?
Well, I remember when Datatec was 140 Rand, and that was 25 years ago.
Yep.
And it's now in the 50s. So, that just shows you what the dot-com bubble was and what it is now. I agree with Graeme that one of the problems for Datatec, and it's a problem for a number of South African companies, is that they are not necessarily best in class if you can invest anywhere.
Yeah.
And one of the effects of the change to Reg 28, where pension funds cannot take 45% of their assets offshore, is it's put pension fund managers in a situation where they only choose the best in class assets in South Africa, and with the other 45%, they buy what is best in class elsewhere. And, I think I've said previously on your program, for example, Sasol.
Yes.
Sasol is by no means the best oil company in the world. It's not in the top 10 or 20 or maybe even in the top 100. So, that's why people have sold Sasol. They've gone offshore and they've bought Total or BP or some other operation. And Datatec is a great business. But if you're going to be in IT hardware, you can't really compare Nvidia to Datatec. Having said that, I think it's a great business. I think Jens is a talented and incentivized manager because he's got a lot of shares himself. And I think the long-term game plan will be for Jens to probably sell this company off as he comes to the end of his career. So I think, would I own it? Short answer, yes.
But I like your point about best in class. Suddenly it's the world, not just the JSE. Question coming through, Shane, let's start with you. Alphabet, the results were great. It's been a couple of picks over the last week or so on this show. The question is, I'm worried about this, the search part, particularly with artificial intelligence. That obviously advertising is a big part of their business. Shane, that's not wrong. Although, Waymo is doing 250,000 rides a week now, I think it is. YouTube is bigger than Netflix in terms of hours watched. Alphabet for you?
So Google and Meta are obviously the two biggest online advertisers in the United States. And I think people are thinking, well, if the economy slows meaningfully, and the first quarter did show a contraction, then ad spend is one of the most variable and discretionary items. I think that, if you want to look at the Mag 7 in general, these companies have attracted a disproportionate amount of global capital. To the extent that 65% of the total global stock market cap sits in the United States, right? There are 50,000 companies around the world listed, and a few hundred companies make up, I guess almost a third of that market cap. So you really have to decide whether these $2, $3, $4 trillion market cap businesses can continue to grow at this rate. So the Mag 7 companies are all 1 to 4 trillion. The US global GDP, the United States GDP, should I say, is only 30 trillion. So if you think about a company like Nvidia, that's 3 trillion. I mean, that market cap is 10% of the United States total GDP. So eventually you can't grow just because you are such a large portion of what you are. But, are they good businesses? Is AI good for them? Would I own them on a long-term view? I think the short answer is yes.
Graeme, likes of Alphabet, I mean, they are an absolute giant and dominate search.
And I think I agree with a lot of what Shane was saying. I think the other thing that is relevant is that dominance actually comes at a price. So, they've been fined more than once. And, if you look particularly at Europe, in terms of, let's call it privacy breaches and stuff like that, it's becoming an issue. And it's going to be, I think, become one of those things that may just weigh. So, for me, when all else fails, I go back to a peg and I say, right, what is this company likely realistically to deliver in terms of earnings growth? Remembering that it's essentially an advertising business in large part, yeah? And I would actually argue in terms of the question that AI is actually helping them because there's more targeted advertising. So at least for a season, that'll probably help sustain it. But I think there are challenges, and not least of which is what Shane is saying. You get so big eventually that it becomes difficult to move the needle. In an ideal world, you would say, when a business has reached maturity, and it's almost like the debate around Exara. You sort of say, well, let's just milk this thing, and if we need to reinvest in new technology, we will find new technologies. But it's almost the case of what is the sustainable earnings growth out of a business that's got that base? And I would argue this is not a 20% earnings growth story, and it'll probably shrink as time goes by. So the valuation is not ridiculous, but I think it's excessive given the realistic prospects that you're going to see out of this thing for the next 2 or 3 years. And then after 3 years, it's anybody's guess in terms of fines and the threats of breakup and that all those issues around dominance and the way they collect and manage and distribute data. So I think I wouldn't be a buyer of it. If you've got it, I definitely wouldn't be a seller right now. But I think there might be more compelling arguments because I think, sorry, I'm rambling on, but what Shane was talking about is exactly right. People sort of say there's this Mag 7 that are AI beneficiaries, but yes, there's a peripheral benefit to companies like Meta and Alphabet and Google. But the reality is NVIDIA's at the coalface in terms of being a beneficiary of AI. So I think you had this wave of excitement around AI, and that created the Mag 7. But they're just proportionately big. If you look at them relative, you take the top 10 in terms of concentration in the S&P 500. I think it's circa 30% at the moment. That's just excessive. So you do get the feeling that the collective are probably due for a re-rating. That was a really rambly answer, but.
No, but I like it. And you both made the great point. I mean, it's a $2 trillion company. I mean, can it 10x to 20 trillion? I mean, sure, but I wouldn't be betting on that in a hurry. Graeme, let's stay with you. We buy cars. New car sales are so-so, but it's all about China and India, lower price points. Surely second-hand cars for the win, and therefore we buy cars. Trading update, a lot of moving parts, but if we strip that out, kind of flat HEPS growth. Your take on we buy cars?
Yeah, look, I mean, I completely misread it, frankly. So you should probably ask somebody else. But I think exactly that the second-hand car market is the place to be. So I think that the Chinese brands are stealing the lunch of the traditional Japanese and maybe German and to a lesser extent Korean producers. And then the other story is obviously used cars. And one of the reasons is that interest rates remain high. Inflation has really eaten over the last few years into disposable income. So, even if people want to go out and buy a new car, they just frankly can't afford it. And, but getting a second-hand car 60% of the 50% of the price tag is probably the only realistic solution. So I think, I was wrong on it before. I think We Buy Cars will have a market and probably a dominant position in that market for some time. Again, it comes back to the valuation. So if you, in a difficult environment, are hardly moving the needle, then the question is, what is the right multiple? I'll hospital pass that to Shane.
Yeah, and to be clear, new cars are eye-watering. Shane, hospital pass to you. What is the right multiple? We Buy Cars attractive for you?
So it's on about a 19 PE forward, and so I think the short answer is no. I think it's a good company, but I think the easy money's been made.
Okay, yep, nice and simple. Last question, quick before we go to stock picks. It's around City Lodge. I've held it since the pandemic. I'm actually in the profit, but it's going nowhere while other stocks are looking more attractive. Is it time to bail on my City Lodge? Shane, would you be exiting City Lodge if you were a holder at this point?
Simon, I don't know a living person that's actually got City Lodge in a profitable position. This company's been an appalling share, right? I mean, they had a rights issue shortly after the pandemic, where existing shareholders were utterly diluted out of the company. So, as I said, I'd like to know who this person is that made money out of this share, but most people haven't. I think that, if I'm dead honest, I think City Lodge deserves more energized management, and I think it's a good business, but really management asleep at the wheel.
Yeah, I'm trying to do
but at R4, we do own it.
Yeah.
And I'm hopeful that sort of things like the G20 being held in Johannesburg will cause an improvement in Johannesburg occupancies. Cape Town obviously is a tourist destination, and the hotels are full generally. City Lodge. What City Lodge needs is they need occupancies north of 70%.
Yeah.
And I think they're kind of sitting in the 55 to 60% range at the moment. So it's very occupancy driven. But still, we are looking for management in general that have a self-help attitude, not management that are just hoping for the economy to improve.
Yeah, and I'm zooming out to your point. After the massive rights issue and then consolidations, I think it was 10 years ago, was 1,150 Rand, but maybe I'm confusing my zeros, and it's now 4 Rand. To your point, not many people in the money here. I need to go to some stock picks. Graeme, you're going with Anglo-American?
Yeah, I very, very seldom would call a commodity stock. But I think the sum of the parts is worth more than the current share price. I think when De Beers and Amplats and the Aussie coal assets are gone, what you'll be left with is a transaction that I think a couple of global miners would consider to be very attractive, particularly BHP Billiton because of their portfolio. So, yeah, I think Anglo-American, and frankly, I quite like the platinum story driven through Amplats because I think the PGMs, you've seen more and more capacity coming offline. So, you've got to have a mildly positive view on Amplats because you're going to get some of those. But I think Anglo's right now is looking like there's money to be made simply as this corporate action unfolds.
Yeah, okay. And it is, it's moving along. It should be done. Although De Beers, they're still going to make a plan for that, but looking attractive. Shane, the Foschini Group, TFG.
Well, in general, Simon, I'm saying I like the apparel retailers. Why? Because of the tariffs. There's now a lot of manufacturing capacity for apparel that's available cheaply in the East. The Rand is stronger. Oil prices are lower. Interest rates will probably be cut twice in South Africa based on the forward curves in the current year. A VAT increase that was going to happen is now no longer going to happen. So I think there are many tailwinds for the apparel retailers. They look cheap. They trade between 8 and 12 times. Foschini's at the upper end of that. But they have, I think, the additional benefit that there's quite a lot of debt on the balance sheet. And as interest rates come down, that variable rate debt will reset. So I think you can buy almost any of the discretionary retailers, but we pick Foschini from here. And I think the management team are competent and they've executed well. And I think Anthony Thunstrom has a vision for what he wants to do, which most investors buy into.
Yeah, I agree 100%. That's all for our Stock Watch today. Thanks to our guests, Shane Watkins from All Weather Capital, going with Fashini Group, Graeme Körner from Körner Perspective, going with Anglo American. Up next, the close. Stay watching.